Welcome to The Explainer. Today, we're jumping right into the machinery of corporate finance and legal compliance, specifically the provisions relating to audits under the Companies Act 2013. We're going to unpack statutory audits. Think of them as the ultimate legal gatekeeping mechanism for companies. It's this incredibly intricate system designed to keep businesses honest, transparent, and, well, accountable. We're going to see exactly how the whole shebang works.
Okay, let's dive into this. Here is our roadmap for today. First, the corporate legal framework. Second, the need for statutory audit. Third, qualifications of an auditor. Fourth, defining a chartered accountant. And finally, Section 141 auditor disqualifications. We're going to transition from the broad nature of a company all the way down to the highly specific legal rules governing exactly who can audit them.
Right, starting with Part 1, the corporate legal framework.
So a company is a pretty unique beast. It's an organization that is entirely a creation of law. Literally every single operation is subject to strict legal provisions. So auditing a company? Yeah, that doesn't just happen in a vacuum. It is exclusively guided by a massive complex web of acts, rules, and judicial pronouncements. We're talking about the Companies Act of 2013, the Chartered Accountants Act of 1949, plus a whole slew of rigorous accounting and auditing standards. Now you might be wondering, why this intense level of scrutiny? Well, it's because companies are the absolute largest consumers of societal resources. So this dense legal framework is absolutely imperative to maintain the highest possible auditing standards.
Which brings us to Part 2, the need for statutory audit. Let's look at the core conflict that makes all these legal frameworks necessary in the first place.
And this brilliantly illustrates the root of the issue: ownership on one side and management on the other. See, shareholders actually own the company's properties, right? But they don't actively take part in the daily management. Instead, a specific group of managers controls the resources. Because of this separation, the management stewardship absolutely must be vouched for by an independent third party. I mean, you can't just take their word for it when we're talking about millions or sometimes billions of dollars.
So that brings us to the statutory audit. Now, the word statutory simply means something regulated by state laws. So this type of independent verification, it isn't just a nice to have. It is absolutely mandatory for every single company. It's essentially the law stepping in to bridge that trust gap between the people who own the money and the people who manage it. The Standards on Auditing, specifically SA 200, defines this beautifully. It says, an audit is independent examination of financial information of any entity when such examination is conducted with a view to expressing an opinion thereon. So it's a holistic, totally impartial appraisal based on facts and actual figures. The auditor's job isn't to assume, it's to verify.
Moving on to Part 3, Qualifications of an Auditor. Let's shift our focus to exactly who is legally entrusted to perform this critical examination.
The law is exceptionally clear on this under Section 141 of the Companies Act, specifically subsections 1 and 2. A person or a firm is only eligible for appointment as a company auditor if they are a chartered accountant, and this applies to firms and LLPs too. But there's a catch. For firms, the majority of its partners practicing in India must be qualified, and crucially, only the partners who actually are chartered accountants are authorized to act and sign on behalf of that firm. But that begs a really important question. What exactly makes someone a chartered accountant in the eyes of the law?
Let's answer that in Part 4, defining a chartered accountant. Because this isn't just a job title, it's a highly specific, legally defined entity. So the crucial point is this: under the 1949 Act, a chartered accountant means a person who is a member of the institute, and you are only a member if your name physically or, well, digitally appears in the register of the institute. Getting your name in that register is the ultimate defining factor of your legal authority to audit.
So how do you actually get on that all-important register? Section 4 outlines a few specific pathways. The most common route, obviously, is passing the prescribed exams and completing some pretty grueling training. But the law also grandfathered in registered accountants who were practicing when the Act began, holders of a government diploma in accountancy, and even those with recognized foreign exam equivalents who complete the training. Ultimately, you generally have to reside or practice in India, formally apply, pay the requisite fees, and actually be accepted to get your name immortalized in that register.
Let's move to Part 5, Section 141, Auditor Disqualifications, and see how this builds into ensuring the auditor remains a true independent gatekeeper.
Because, getting qualified is really just half the battle. Staying qualified means navigating a total minefield of strict disqualifications. These broad bans are your first layer of defense against conflicts of interest, So, a body corporate cannot be an auditor, though they do make an exception for LLPs. And obviously, an officer or employee of the company itself cannot audit their own books. I mean, that would completely defeat the entire purpose of an independent appraisal, right?
But the law goes even further to prevent indirect influence. If you're a partner of, or if you're employed by, an officer or employee of the company, boom, you are disqualified. The legal framework builds this solid firewall, ensuring that close associates of company officers can't just swoop in and provide a friendly, heavily biased audit.
Now, what's really interesting about this specific rule is where the financial boundaries are drawn. An auditor cannot hold any security or interest in the company they're auditing. None. Zero. However, there is a tiny bit of leeway for their relatives. A relative of the auditor can hold security or interest in the company, but it is strictly capped at a face value of 1 lakh rupees. So, 100,000 rupees. The second it goes over that limit, the auditor is instantly disqualified. And here's another fascinating restriction to ensure quality and independence. An auditor, or a partner of a firm, is disqualified if they hold appointments in more than 20 companies. Now, sensibly, this cap excludes one-person companies, dormant companies, small companies, and private companies with a paid-up share capital of less than 100 crore rupees. But for major corporate audits, that 20-company limit ensures the auditor isn't stretched too thin to actually do a proper job.
The independence net just keeps getting wider here. You are completely banned if you're in full-time employment elsewhere. Furthermore, if you or your firm have a direct or indirect business relationship with the company, its subsidiaries, or its holding company, you're out. Oh, and having a relative who is a director or key managerial personnel, that instantly triggers a disqualification too. The whole goal is to eliminate literally any possible leverage the company might have over the auditor.
And finally, the ultimate penalty for breaching trust. If a person has been convicted by a court of an offense involving fraud, they are outright banned from being an auditor until 10 whole years have elapsed since their conviction. No exceptions. The system demands absolutely impeccable integrity.
Which brings us to a final thought for you to ponder today. We've seen the incredible depths of the Companies Act 2013 and these intensely strict boundaries of Section 141. We've seen how the law attempts to engineer perfect impartiality. But looking at all these legal disqualifications, one really has to ask, is true independence ever genuinely guaranteed by the human mind, or is it just something we can only hope to legally enforce? It's a fascinating reality of the corporate world, where trust is good, but statutory verification is mandatory.
And completely masters Section 141(3) of the Companies Act 2013. If you're a CMA student preparing for your exams, you already know that auditor qualifications and disqualifications are an absolute favorite for examiners. So our goal today is to guarantee you crush these disqualification questions by breaking down all that dense legal text into crystal clear visual concepts. To make this super easy to memorize, we're going to break this statute down into 5 easy-to-digest buckets. Intro to Section 141(3), financial and investment limits, business and personal relationships, prohibited services under 144, and finally, post-appointment casual vacancies. Let's get to it.
So, bucket number 1, Intro to Section 141(3).
The whole foundational principle of any audit is, well, independence, right? You literally can't objectively check the homework if you're the one who wrote it. So anyone closely tied to the company's daily operations is strictly barred. If you're an officer or an employee of the company, you are out. But watch out, it actually goes a step further. If you are a partner of an employee or if you're in the employment of an officer of that company, you're equally disqualified. The law casts a really wide net here just to prevent any hint of a conflict of interest. Now, here is a classic rule versus exception trap that examiners absolutely love. The general rule is that a standard body corporate cannot be appointed as a company auditor. However, and this is a big however, a limited liability partnership, an LLP registered under the 2008 Act, is perfectly eligible. Why is that? Well, it's because an LLP combines limited liability with the internal flexibility of a partnership. It allows the actual accountability to remain with the individual professional partners who are signing off on the audit. So, do not let the examiner trick you into thinking an LLP is a disqualified body corporate.
Moving right along to bucket 2, financial and investment limits.
This brings us to a massively tested area, the exact numerical thresholds, 1 lakh. That is the magic number for securities. The general rule is super strict. If a person, their partner, or their relative holds any security or interest in the company, its subsidiary, holding company, or associate company, it's a direct disqualification. But wait, there is a very specific trick here, a carve-out that you must know.
And this perfectly illustrates the exception you absolutely have to memorize. While the auditor or their partner cannot hold a single share, like literally zero tolerance there, a relative actually can hold securities, but strictly up to a face value not exceeding rupees 1 lakh. Keep that distinction crystal clear.
Okay, watch out for this next threshold on your exam, the indebtedness limit. An auditor is disqualified if they, their relative, or their partner are indebted to the company or its affiliates for an amount in excess of rupees 5 lakhs. Notice how the limit just jumped there, from 1 lakh for securities up to 5 lakhs for debt.
And similarly, you need to lock in this 1 lakh threshold, which applies to guarantees. If the auditor, relative, or partner has given a guarantee or provided any security for a third person's debt to the company and that amount exceeds rupees 1 lakh, bam, disqualification. So memorize this numerical trio: 1 lakh for a relative's securities, 5 lakhs for debt, and 1 lakh for guarantees.
All right, on to our third bucket, business and personal relationships. You know, independence isn't just about shares and loans. It's about commercial and family ties, too. The law strictly disqualifies anyone with a direct or indirect business relationship with the company, its subsidiaries, or holding companies. And generally, that just means any transaction entered into for a commercial purpose. Basically, if the auditor is moonlighting as a major raw material supplier for the company, their objectivity is totally compromised.
But, of course, we have exceptions to save the day. The crucial takeaway here is that buying a plane ticket from an airline you audit or staying in a hotel they own at a normal market price doesn't disqualify you. It falls safely under the arm's-length commercial transaction exception. Also, any standard professional services that are permitted by the Companies Act or the Chartered Accountants Act, those don't count as a prohibited business relationship either. Now, on the personal side, it is a hard, inflexible rule. If your relative is a director or they're employed by the company as key managerial personnel, think CEO, CFO, company secretary, you simply cannot be their auditor. The risk of collusion or just a lack of professional skepticism is way too high when family is running the show.
Next up, Bucket 4, Professional Limits and Legalities.
First off, if an auditor is in full-time employment somewhere else, they are out. And for practicing auditors, there's a strict ceiling. You absolutely cannot hold an appointment as auditor for more than 20 companies at the date of your appointment.
Furthermore, character really matters. If a person has been convicted by a court for an offense involving fraud, they are disqualified from acting as an auditor until a full 10 years have elapsed from the date of conviction. Not 5, not 7, a full decade has to pass.
Let's look at the next part, prohibited services under Section 144.
This is a highly critical area for your exams. Section 144 explicitly lists services you just cannot provide to the company or its affiliates directly or indirectly. Take a mental screenshot of this list right now. Accounting and bookkeeping, internal audit, designing or implementing financial information systems, actuarial services, investment advisory and banking, outsourced financial services, and management services. Providing any of these automatically triggers disqualification. I mean, you can't design a company's financial system and then independently audit it, right? Makes perfect sense.
Okay, so here's a twist examiners love to throw at you. What happens if an auditor was perfectly qualified on day 1, but then, say 6 months down the line, they inherit shares? Or their relative takes out a massive loan from the company, or maybe they take on a 21st audit?
That brings us to our final bucket, post-appointment casual vacancies.
This exact scenario is governed by Section 141(4), and the rule is absolute. The very moment any of those Section 141(3) disqualifications are triggered, whether it's hitting the debt limit, starting a new business relationship, whatever it is, the auditor must immediately vacate the office. They do not get to just finish out the financial year. The law deems this sudden exit a casual vacancy, which the board of directors then has to fill according to specific procedures.
And that covers the entire landscape of Section 141(3) and 4. Review these categories and definitely make sure you memorize those 1 lakh and 5 lakh financial limits, plus that 20 company ceiling. You are going to crush those exam questions. But before you go, ask yourself this. As the corporate world gets more and more interconnected through complex tech ecosystems, are these rigid numerical limits still enough to guarantee true auditor independence? Or is it time for the law to evolve again? Something to think about as you study.
Think of this explainer as your ultimate, highly visual exam cheat sheet. We're going to take the dense, often super complicated legal text surrounding the appointment of a company auditor and break it down into a clean roadmap that's actually going to stick in your memory long after test day. So let's kick things off with a classic exam question, right? Who actually holds the power to appoint the auditor of a company? Is it the board of directors, the shareholders, the government? Well, as any good law student knows, the answer is usually it depends. And in this case, it depends entirely on the type of company we're dealing with. Here's a quick look at a roadmap for today. We'll start with appointing the first auditor, move into subsequent appointments, tackle how to handle casual vacancies, and wrap up with term limits and rotation. Let's get into it. Now, the very first thing we absolutely have to establish is what makes a government company, because the rules of Section 139 split right down the middle based on this definition. A government company is any company where not less than 51% of the paid-up share capital is held by the central government, a state government, or a combination of both. And remember, this includes any subsidiary of a government company too. Lock that 51% rule into your brain right now. It's literally the gateway to knowing which set of rules to apply on your exam. All right, let's dive into Section 1, appointing the first auditor. For non-government companies, this if this, then that timeline is pure exam gold. So pay close attention to how the power cascades here. Starting from the exact date of registration, the board of directors has exactly 30 days to appoint that first auditor. But what if they drop the ball? The power immediately shifts. The board has to inform the members of the company, and those members then get 90 days to appoint the auditor at an extraordinary general meeting, or EGM. That gives us a hard maximum deadline of 120 days from registration. Now, flip the script for a government company. Here, the Comptroller and Auditor General of India, the KAG, gets a total VIP first pass. The KAG has 60 days from registration to make that appointment. If they miss the deadline, the power drops to the board of directors for the next 30 days. And if the board also fails, it finally cascades down to the members, who get 60 days to make the appointment at an EGM. It's basically a three-step safety net. But check this out. Here's the one thing both company types actually agree on, and examiners love using this as a trick question. Regardless of whether it's a government or non-government company, and completely regardless of who actually made the appointment, the first auditor's term is identical. They hold office only until the conclusion of the very first annual general meeting. Keep that in your back pocket. Moving right along to Section 2, subsequent auditor appointments. For non-government companies transitioning into their normal life cycle, you've got to memorize this strict three-step sequence. Before an appointment is even made, you absolutely must obtain written consent and a certificate proving the appointment meets prescribed conditions and satisfies Section 141 criteria. Next, the appointment is officially made by members at that first AGM. And finally, this is a massive detail for your exams. The company must file Form ADT1 with the registrar within a super strict 15-day window. Meanwhile, over on the government company side, lock this massive number into your memory: 180 days. The whole process is different here. The CAG steps back in, and they have 180 days from the commencement of the financial year to appoint the subsequent auditor. Notice that crucial trigger date, guys. It's not from the AGM, it's from the start of the financial year. You'll definitely notice the stark difference in tenure here, too. For non-government companies, auditors get to settle in for a solid 5-year block, holding office from the conclusion of that first AGM all the way until the conclusion of the 6th AGM. But government auditors, they essentially live year to year, holding office only until the conclusion of the next AGM. Okay, so that perfectly covers the normal course of business. But as we all know, corporate life rarely goes exactly to plan. What happens if the auditor unexpectedly resigns, gets disqualified, or even passes away right in the middle of their term? Which brings us to Section 3, handling casual vacancies. The absolute golden rule for casual vacancies across the board is a swift 30 days. You just don't have time to wait around. For non-government entities, the board of directors has to step up and fill the vacancy within 30 days. For government entities, it's the CAG who must fill it within 30 days. And if the CAG fails, the board gets the subsequent 30 days to fix it. Pretty straightforward, right? We'll pay close attention, because here is the exact trap they love to set on the CMA exam. If the casual vacancy happens specifically because the auditor resigned in a non-government company, the board cannot act completely alone. Sure, they propose a replacement within 30 days, but that appointment absolutely must be approved by the members at a general meeting, and that meeting has to be convened within 3 months of the board's recommendation. Resignation always triggers member oversight. Do not let them trick you on that. And finally, we arrive at Section 4, term limits and rotation. Want a quick cheat code for the exam? Just draw a rough version of this matrix in the margins of your scratch paper. To keep auditors from getting too comfortable, listed companies have strict limits. An individual acting as an auditor gets a maximum of 1 term of 5 consecutive years. An audit firm gets a little more runway, with a maximum of 2 terms of 5 consecutive years. And once they hit that limit, both face a mandatory 5-year cooling-off period before they can touch that company again. As a quick added bonus for your prep, remember that simply rotating the auditor isn't the whole story. The auditor has to remain entirely independent while they're on the job. Section 144 strictly outlines prohibited secondary services. This means an auditor cannot provide accounting, internal audits, investment advisory, or management services to the exact same company they're auditing. It's a hard boundary to ensure the audit report remains an objective, unbiased reflection of the company's financial health. I'm going to leave you with this final thought to ponder while you review your notes. If the executives on the board completely drop the ball, and if the government drops the ball, the true power to appoint always eventually cascades down to the shareholders. It kind of makes you wonder, though, if shareholders hold the ultimate safety net, are they actually exercising that power effectively in modern corporate governance? Keep that underlying principle of shareholder power in mind, and navigating Section 139 will be an absolute breeze for you. Best of luck on those exams.